Hey guys, how's it going? Lewis Hague Investor here and welcome back to my channel. And in today's video, I'm going to be analysing RDS stock. I'll be using fundamental analysis to see if the company is worth buying or not. I'll be then using a DCF valuation to determine the fair value of the company. Let's get straight into it. Who are RDS Shell? So RDS Shell plc, commonly known as Shell, is a Dutch multinational oil and gas company headquartered in the Hague, Netherlands, but incorporated in the United Kingdom, and they are listed on the London Stock Exchange. So they're one of the largest oil companies in the world, known as one of the supermajors, and based on 2020 revenues, they are the 5th largest company in the world, although that doesn't really mean anything, to be totally honest. Anyway, so Shell is vertically integrated and it is active in every area of the oil and gas industry, including exploration, production, refining, transport, you name it, you can read it. They're into basically all aspects of oil and gas. But we're also looking into renewable energy now, such as biofuels, hydrogen and wind. They operate in 70 countries, so they're a truly worldwide business. Shell was formed in 1907 through the merger of the Royal Dutch Petroleum Company and Shell Transport and Trading Company. So yeah, it's a Dutch and British company, similar to Unilever in some ways. And yeah, so they have a primary listing on the London Stock Exchange and they're one of the biggest constituents of the FTSE 100 index. Now we know a bit about the business, let's have a look at the sales. So 76% comes from oil products, 20% from integrated gas, and 7% from chemicals, 4% from upstream. So the vast majority is oil. Then looking at the sales breakdown, where do they get their sales from? Pretty broken down around the world, to be fair. The US and Europe are very similar, and then Asia is at the top with 38%, then the other countries make up the remainder. Now let's have a look at the income statement, and this data has come from Macro Trends and it is all in US dollars. So from 2016 to 2018 the revenue was rising, 2019 a bit of a slip up, and then in 2020 the revenue completely crashes compared to previous years, and this is due to the pandemic and oil prices absolutely collapsing. So you can see this business is heavily reliant on the oil price, and this will ultimately determine how much revenue they bring in. So this is a big risk in terms of investing in oil companies in general. Then looking at the income after tax, or net income. Yeah, inconsistent across the board, not what we really like to see. As you can see, the higher the revenue, the higher the net income. But even more, this is even more important for oil and gas companies because it fully depends on the oil price and how much does it cost them to bring oil out of the ground. Minus net income in 2020, not really surprised in terms of Shell. Now let's have a look at the balance sheet, and it doesn't make for good reading really, does it, when you have a look? The key figures I really look at is a long-term debt, the number one figure. From 2016 to 2020 this is just fully increased. Due to the pandemic they'll have taken more debt on to get through the crisis, but even during the good years when they were making profit they've been taking on more debt, so this is not a good sign at all. And then looking at the common stock, they have been buying back shares slightly, not great, not too much. Then returned earnings, their profits over time, decreasing. It's pretty stagnant. This is probably due to the dividends we've been paying out, so a lot of the profits will be paid out as dividends. Then in 2020 the returned earnings have taken a big hit, which is no surprise, to be fair. Now let's have a look at the cash flow statement, and the first figures we're going to be looking at is the cash flow from operations and the capital expenditures figures. Yeah, you can see over the past 5 years they have had positive free cash flow, which is a very good sign. Pretty inconsistent though, alongside the revenue, so this is no surprise. The free cash flow will follow what the profit does, and this ultimately depends on what the oil price does, so no real surprise. But yeah, it's good to see this is a positive figure. With oil companies, they do have a lot of capex, so it's something to bear in mind. A lot of their cash flow does get taken up in capex, so yeah, a bit of a thing to watch out for oil companies. Let's have a look at the long-term debt. Yes, we saw it on the balance sheet. It increased in 2016, decreased, then increased because of the pandemic. And then looking at the dividends, I like to see this going up over time because it shows their for growing the dividend over time. It's good for investors. But yeah, in 2020, Shell cut their dividend for the first time in 50 odd years, which was a very big deal for this company. The right decision in the end, but still a very tough decision for the management to make. Now onto the overview of the key financial ratios, and having a quick glance over before we go to the analysis checklist. The current ratio is above 1, which is obviously a good sign. The long-term debt to capital is relatively low, which is good, and they kind of need that with inconsistent profits and cash flow. They can't have a lot of debt on the balance sheet because it'll be, bye-bye bankruptcy in bad times. So the margins on oil businesses are never really that good, and it's one reason I'm not really that bothered about investing in them, apart from one, of course. There's a good reason for that, which is Equinor, by the way. Return on equity, pretty poor as well, apart from 2018, which was getting a bit higher. Not great across the board, but let's have a look at my analysis checklist to have a real understanding of what I'm looking for when potentially investing into Shell. So now to my analysis checklist, and let's have a quick look. So the market cap of the company, I don't think that's quite right. I think that's been taken into euros, because I think the market cap is below £100 billion, but I might be wrong there. The current price, this was taken from a few weeks ago when I did my free stocks to buy now series. So I think the price is a similar amount now. Doesn't really matter, to be fair. But then going on to pillar 1 and looking at the gross profit margins, net profit margins, not very good. Like we saw on the last page, 5-year average, not great. Not what I like to see in a business long term. Return on equity as well, poor, not good, in the red. Thankfully, the debt situation and the current ratio are in the green, so that's a positive sign, but it doesn't really make up for the bad margins and bad return on equity, which ultimately determine a higher quality business. Proven ability to grow. I think this has been proven wrong. I know COVID pandemic was an anomaly probably, but still, over the past 5 years, their revenue, net income and shareholder equity has gone down, although the free cash flow has gone up, so a bit of an odd one and something to look into more in their financial statements. Great capital allocation, so long-term debt has gone up because of the pandemic, dividend has been cut because of the pandemic, so maybe you can take that into consideration, and maybe with the oil price being higher now, they'll have a blockbuster year in 2021, but that remains to be seen, and we will see if that dividend gets put to as high as it was before. Decreasing shares, yes, there have been decreasing shares at a very small amount. Good acquisitions, I'd say they have. After having a quick Google, they've acquired all sorts of businesses in the renewable space recently, trying to pivot their business from oil and gas to renewables over the next few decades. PodPoint is a company which they bought, electric charging, so PodPoint, basically, if you have like chargers near lampposts and you can charge your electric car, so that's what that business is, and they acquired them a few years ago. Buy at a fair price, so there's no PE ratio because there's no earnings. However, the price to free cash flow ratio is looking quite low for this business based on what free cash flow they produce. And this shows in the DCF valuation for a 10% return, we're looking at a share price of £28. So we will get onto this, and the current share price is looking at a decent return. So let's have a look on the DCF valuation and we'll have a talk through the numbers. Now let's have a look at my discounted free cash flow valuation for RDS Shell, and taking my free cash flow figures from analyst estimates and discounting them at a rate of 10%. And getting to a share price of £28. So from the current share price of around £13-14, it's not looking too bad in terms of returns on a cash flow basis. So if you are interested in investing in oil and gas companies, maybe Shell is a good option. You have to do more research, of course, but from these levels, it's looking quite interesting for sure. So what are my thoughts on RDS Shell? So in terms of the stock, it's looking pretty undervalued right now, and if you're looking for oil and gas companies to invest in, maybe this is a good fit for your portfolio, who knows? It depends what your goals are, what your ethics are as well, if you want to invest in oil and gas companies, but across the board they are looking pretty undervalued. So with a share price of £17, I just had a quick Google, my Excel was a bit out unfortunately, but still from £17 to £28, you're looking at a decent capital gain there, and alongside the dividends you're going to receive from Shell, not too bad going. So if you're comfortable investing in Shell, it might be a good pick. You'll be very wary on the oil price, because if that oil price collapses or it stays at below a certain amount for a certain time, Shell will not make any money, so you've got to bear that in mind. but at current prices Shell is looking like a decent deal. But obviously do your own research and don't just listen to me, this fool on the internet talking about stocks. Do your own research, read the annual reports and come to your own conclusion. So thank you very much for watching today's video. I really hope you enjoyed it, and if you want more investing content, please subscribe on Patreon, become a member today and get full exclusive access to me, my Discord, what I'm invested in, what investment opportunities I'm looking at, and exclusive content. I'm going to be investing in an investment property soon, so more behind the scenes footage on that, and other investments I'm looking at, such as my venture capital investments on Crowdcube. I'll give you insight on what I'm looking at on there as well. So if you want to get full access to me, please go to Patreon. If you enjoyed today's video, please leave a like and a comment, as it really does help me out and it helps out the YouTube algorithm, getting my word out there to more budding investors. Thank you very much for watching. I will see you next time. Thank you for watching. As always, it would be amazing if you could like, comment and subscribe to the channel if you enjoyed this video. I will see you in the next one. However, you can check out some of these videos.